am going to introduce the format of the session really fast. And thank you again, Cheryl, for joining us. So can I have everyone who is not presenting mute themselves if they're not already muted? And then also someone is sharing their screen. I'm not sure who that is. I don't know why there's someone who's sharing their screen. So maybe M. Bashir, if you can not share your screen anymore. Okay. Someone has shared their screen by accident. Anyway, so Cheryl, what we're going to do is, thank you so much for joining us for this hour. We're going to have 3 teams talk to you for 20 minutes each. This is basically same thing as they would if they were entering into office hours with you. So they're being asked to briefly describe their product to you and then to get advice from you. So the idea is to be as honest and as direct as possible because, you know, your feedback is invaluable, and we're making this available to the whole community. So there's over 100 people right now logged on to listen in. They will not be participating, but they will be listening in and taking note of your advice and also learning from the feedback that you give. So like I said, there's 3 teams. It's 20 minutes each. Before we go, I just want to introduce you again that Cheryl is joining us, completely volunteering her time. She's a general partner at BlueRun Ventures, and BlueRun is a very well-known early-stage VC fund focused on mobile software and services. And Cheryl focuses on early-stage mobile and real-time data opportunities. And her investments include Hello Heart, Sendwithus, and ZeeMee. And she and I met actually not so long ago, just a few months ago, at a women's, investor and entrepreneur event. And she mentioned that she's really into emotional well-being and wellness. So thank you so much, Cheryl, for joining us. And I would like to go straight on to the next, to our first startup. Our first startup is Beamon. Are you here? Beamon, can you message if you're here? Okay. Is Madeline presenting today? Sorry, I have everyone muted, so I'm trying to figure out.
Yes. Yeah, hi, I'm here.
So why don't you go first, Madeline? And then, so you get the next 20 minutes. I'm gonna have to cut you off at 18 because we started off a little late due to technical difficulties. And then, so Madeline, please introduce yourself. And then everyone else, please keep yourself muted and listen to the office hours. Thank you, go ahead.
Hi everyone. And hi Cheryl, thank you so much for having me on. I guess I'll just start out by giving a quick background. You've obviously seen the blurb of the business in the invite. So I'm the CEO and founder of Neville. Our mission is to eliminate burnout. That's really been inspired, honestly, by personal experience, observing that in companies, but also the scale of this problem, the complexity of it, which I'm pretty passionate about. Our current product is a platform that helps communities build awareness of their well-being and what drives that and take action to improve their lives and work. So the market that we're selling into at the moment is the B2B HR tech market. So our main competitors are engagement and well-being platforms, but also culture and feedback tools, and then kind of edging into consultants and work transformation. And just quickly kind of where we are today. Basically, I started the company after doing about 5-6 months of research into organizational psychology, the drivers of stress, performance, burnout, but also well-being, and working with my research co-founder to create kind of an integrated model that we're using as the base for product development. And then we have been doing market testing, customer conversations. Sort of early this year, launched, actually just about to launch our MVP kind of beta product. And we're testing it with 3 pilot clients starting this fall, 1 starting this month, and continuing to build our pipeline. So I've bootstrapped to date, and I'm now putting together a fundraising deck and going to be going out to raise funding. So I think my questions are going to be a bit around fundraising and also a bit about company strategy, if that's okay with you.
Yeah, absolutely. So interesting. So do you have an MVP that you can show both customers and investors, right? Like it's ready.
Yeah, I mean, we're polishing it, but in terms of I can show it, yes, yeah.
Okay.
Yeah.
And do you have any like alpha data in terms of how the product works or how well it works?
No, I've only got loads of user research interview questions and that kind of thing. And then from it being actually live and being able to say, people log into it at this point, this is how much we're getting, this is what the data structure looks like when it comes back, this is how people are using it. We don't have any of that because that's really, we're waiting, that should be coming from our pilots over the next sort of 3 months or so.
Okay, got it. Makes sense. Okay, so I totally understand the category. I think it's a huge category, but it is a murky category. So
yes.
you need to have some very clear, this isn't even just for investors, right? It's actually just for yourself. Like you need to have some very clear KPIs of like how the product will perform that makes you happy with it and will also delight the customer. Because I think there's a lot of things in this space right now, and there will be more, and a lot of it is going to be like snake oil, and you need to you need to really be able to, in an ideal world, get to a place where there's a peer review paper that gets done about your solution.
Yep.
Almost like clinical research, right?
Yeah.
Now, I know you're not in a position to do that now, and I'm not saying that you should go spend money on it, but you should start asking the right questions to position yourself to do that type of research, because that will make a huge difference in your ability to sell into corporate customers.
Yeah.
So I think that's one thing that even at the early stage, you need to like lay down the foundation for.
Can I ask you a question about that, actually?
Yeah, absolutely.
So that's really interesting. That resonates with me a lot. What we found to date is that if you think of the market in terms of where companies are focused from this whole perspective of like people well-being, work, culture, transformation, you've got one end, which is, let's call it like frontier companies that are everything's great and they want to just make sure it stays that way, right? They kind of want to do it better. And so interestingly, that's one side. And the other side are companies so they're like opportunity. We want to platform this. We want to show that we're investing in it. And then the other side are these behemoth mature companies that really have a large pain point in things like burnout and mass disengagement. And they need a pretty deep structural solution, but ideally that can be delivered iteratively, low risk through technology that's going to help them start to work through that. And we've basically gotten hooks on both those sides, which is quite interesting. So from your perspective of KPIs, I'm kind of asking myself, the KPIs on this side of the market are basically burnout and engagement. We know how to measure that. And we've actually built that into it's like a kind of baseline that we take at the beginning of when you're setting up the product. But on this side, they're like a little bit, it doesn't matter as much, right? It's going to be more around performance KPI metrics of the teams and product engagement. So I'm kind of asking myself, like, is this the strategic decision for us now where we just need to focus on one end of that market? Or are we going to be able to work both of them and kind of squeeze the middle. Do you know what I mean?
I do. I think ultimately both types of customers will end up in the same place. You know, the one thing I would just caution you about is that I have a digital health company, and I've looked at a number of them. When you go into the world of selling to employee benefits, these are conservative people. And so their metrics, you know, they actually are very numbers driven. And so they're going to want to see, you know, high engagement numbers. They want to see ROI on the dollars that they spend. And when you're in kind of murkier, squishier type of health areas, and, you know, mental health is one of them, it becomes really difficult to really pin down, like, you know, what are my engagement numbers. What I can tell you is that, like, the sales cycle for these contracts can be really long. And so you don't, in the early days, you could say, all right, I'm going to go after smaller companies where the sales cycle is less and they're looking for a different metric. That's fine. But ultimately, to move upstream, you're going to need to get to the other side anyways, right?
Yeah.
So it's kind of a sooner or later thing. And it's kind of how you structure it. The other piece that I would say is, you know, it doesn't give me like complete pause, but, like, you know, I would be asking as an investor is, you know, what does it look like from the ROI perspective to the customer? You know, are you really able to, and what I mean by that is, if you want to deliver really high ROI, do you need a human on the other side? So your technology may be triaging, but ultimately, do you need, let's say, you know, a mental health counselor, or do you need somebody to step in and, like, intervene? I don't know very much about your solution, so I you know, I can't really say. But if you get to a place where you ultimately, this needs to get back to a human, then the question is, okay, well, how scalable is your business? And are you really a technology-enabled service for these mental health counselors? Or is your value proposition strong enough without ever having to engage a human? Or one human can service, let's say, 2,000, 3,000 people, because the machine does so much before it actually gets to the human. So that's something that I've always been watching for in this space specifically, because I love it. I've just seen a lot of companies kind of lose that scalability, because for them to have the efficacy, they need a human on the other side.
Yeah.
And I don't know the answer in your case, right? Like, I'm just saying, like, as you go through this beta and you go through these pilots, those are questions for you and your team to ask of the solution, so that you can deliver, because the highest efficacy would be to put humans there, but, like, that's clearly not cost effective. So how much can technology do before it needs to hand off? Or maybe in your case, it never needs to, just depending on what the value proposition is. But that's something that I would look at.
Yeah, no, it's a really good point. I mean, the interesting thing is, and this is kind of what the research says as well, that actually from a burnout and engagement perspective, the key drivers are work-related drivers rather than individual, you know, so being on the preventative end, we actually, the value driver for the companies is actually the structured feedback that we can provide on the underlying, basically job specific and then organization level factor that.
Got it.
Yeah. So from a value drive perspective, basically what we expect is that we'll be able to renew contracts on the basis of the quality of the feedback that we're getting for them and our ability to structure it in a meaningful way that's just 10 times better than the type of things that are coming out of your typical engagement platform, because they're integrating the underlying insights on the well-being side and the kind of burnout and engagement driver side. Plus, we're also using like free text data, which is an advancement in this market in terms of product features. So yeah, that's our hypothesis, I guess. I do have a question on timing of raise, which probably would be relevant for others out there as well. So I thought that this would be a good time because we've just secured pilot commitments. So it's a demonstration that our vision, kind of bringing well-being into the work culture and performance management, we'd be able to hook advocates. We've got early adopters who have a pain point. They love us. They want us. But the product's simple, and we still have a lot of testing and feedback to do before we've got quote unquote product engagement data. So what would you say about raise timing and how I should position this?
I don't mean to flip the question back to you.
Yeah.
But how long do you think it will take users to be on your system before you can demonstrate ROI?
So if we could if we could produce a complete feedback cycle, I guess from that perspective, we could, I guess we probably do it in a month, realistically, with our first client. It'd be a small point, but it'd be showing value. It'd be showing how it works.
Okay. All right. So the reason why I asked is ideally, so you have two options. One, you can raise a very small amount of money.
Yeah.
Very small. Call it 200 to 500K, right? Yeah. It's not going to get you very far, but it'll probably get you maybe about 6 months, right? 6 months, maybe a little bit more than that. Let's call these small paid pilots. What that will get you is it'll get you multiple months. It'll basically get you 3 to 4 months of data where you can show that it's working, people are liking it, they're re-engaging, they're increasing their usage, right? Mm-hmm. Directionally, you should be able to see that. If you don't, you have a problem, right? And you need to go in and fix it before you can keep going.
Yeah.
So if you raise a small amount of money, you can get that far. And I would say that's the minimum that you need to raise.
Yeah.
If you have the ability to raise more, I would raise no more than 1.5, actually. Mm-hmm. Because you don't want to take unnecessary dilution if you don't have to. And what that would get you is, let's call it a year to 14, 15 months, in which case you have the opportunity to not only have all these pilots go through, but you have the ability to see whether these pilots convert to full contracts.
Yeah.
And if you get enough time to be able to convert to full contracts, now you suddenly can get a good step up in valuation in the next round, because you can show that not only you can land a contract, but you can actually expand it, right? And that's sort of the whole thrill in the benefits world. It's so hard to do. So there are startups that are I have 20 customers, 30 customers, and then you realize they're all little pilots and nobody's converting to full contract. And so being able to demonstrate that is worth a lot. And it may just take time, because the problem in the benefits world is they only buy once a year.
Yeah.
So you need a full year in the cycle to be able to get into full contract mode. So I guess my advice is, if you can raise 1 to 1.25, do it, right? Mm-hmm. So that you can give yourself the runway, and you can do it on the back of saying, hey, I have these pilots and they're paid pilots, and I'm getting good data. If you can't, and you end up only being able to pull together 250 to 500K, take it, run with it, see what you can do in 6 months to kind of get some good trajectory data, and then go out and raise $1 million, $1.5 million.
That makes sense. Yeah, that's exactly what I was thinking. It's interesting. I mean, I've had a couple of combos, more pre-seed investors here in the UK, actually only one. And I think it could be just because they're not that experienced in B2B, but I was kind of going and explaining this and was getting actually the pushback on, we want to see you're able to close more clients and that you kind of have your sales process figured out. And I was kind of confused by that, because I thought it's not really the point in this product to be doing that. I should be showing that I can prove the product.
Well,
so
the problem
that,
is that there's a lot of bodies buried in there's a lot of bodies buried in HR tech and benefits, and
right.
so there's a lot of VCs that have invested in the optimistic view that like we can convert these to full contracts, and they haven't converted.
Right.
And so I think there's a little bit of the once bit, twice shy problem in this space. Unfortunately, because there has been a lot of activity that hasn't always been fruitful. So I think that's why they're asking you for that. And I mean, but the other thing is they may not be the best investor for you at this stage, right? They may be more of a seed or post-seed or maybe even a Series A investor. And that's fine. It's just like at the early stages, you need to know, or you need to start to figure out in like one or two questions, like, are you the right investor for me to talk to at this stage?
Right. Yeah.
So that could be the case as well.
I guess I'm probably not sure about time. I don't know if Rue's gonna.
Yeah. I was just about. Thank you, Madeline, for keeping track of time. So thanks so much. Hopefully that was helpful. We'll go straight on to our next company, because this is just boom, boom, boom. So our next one is Christian Villamarin, who is representing Flipped. So Christian, go ahead. You get your 20 minutes with Cheryl.
Hi, Cheryl. So yes, my name is Christian Villamarin. I'm the co-founder and CEO of Flipped.
Hi.
Very nice to meet you. So I guess I'll start with giving you a little bit of a background of what we are, what we do, how we got here, and then I have a couple of questions on market, direction, and competition. But first, I'll start with starting a little bit of how I got started, or how I got inspired to start Flipped. And it was because I gave my teenage brother his very first smartphone, and almost right in front of my eyes, I saw him completely change from someone that used to tell me everything about his life to someone that this device kind of started sucking his life away. Mm-hmm. So we set on a mission to teach people how to have a healthy relationship with technology, and we wanted to make it socially acceptable to disconnect. So in pretty much Flipped is like a Fitbit for your screen time. We quantify your life based on time spent away from your screen, rather than steps. And similar to Fitbit, we provide you with stats and challenges, and because we're in the business of shaping behavior. We have about 450,000 users around the world. We're about to hit 1 billion minutes flipped off. And what's really exciting about 1 billion minutes flipped off is that Flipped doesn't run in the background. These are conscious minutes that people have selected to flip off. So whether it's a 10-minute session or a 24-hour session, it's exciting to see that as a community, we're about to hit that amount of time spent flipped off. And the way that we generate, who do we sell to? We started as a consumer product where anyone can go to the App Store and download the app, and we have about a 4% conversion. But we also started noticing that a lot of people that were using Flip were students. So we started distributing Flip through university classrooms across the United States. And that we work with university professors that have a huge challenge with kids being on their phones, and then they encourage them to use Flip during class. So that's sort of a little bit about Flip and how we got started and where we are today.
Got it. Great.
So based on that, my first question will be about market size. So how does one describe market size if the market is still being defined? When we talk about digital wellness or transformative technology, there is a lot of names for it. But right now there is, corporate wellness that are trying to get people to not get burned out. There is self-care technology, and that's what we see in apps like Headspace, Calm, meditation apps. And we also started to see another part of the market that it's sort of like digital detox retreats or yoga retreats. So my question is, how does one describe this in market size when it's still a very new market in comparison to when you're in a very specific market like EdTech?
Yeah. Interesting. Well, so technically, your market is anybody who owns a smartphone, right? And I don't mean that in a glib way, but it is sort of true. I think that people will define it in one of two ways. You can either define it from a user perspective, and you can look at proxies like you said, like Headspace, like Fitbit, like other wellness platforms. So you can take it from the health angle. The other way that you can look at it is in terms of dollars. So the other way to do market size is to take a look at what is the cost in dollars for society around people having kind of digital addiction, right? Like whatever that is. And there are both direct and indirect costs to it. You would have to do more research, but, kind of looking at, actually, is there lost productivity, right? Is there social disengagement? Like what is that costing people? Things like that. And so the two ways that I've seen entrepreneurs really quantify market sizes, either through numbers or through dollars. However, in your case, you are in an emerging category, and I think that your job as the entrepreneur to us as investors is to lay the breadcrumb for us to visualize the fact that this is an emerging problem that's only going to get bigger. And what that cost will be is large but undefined. However, is there a solution that we can actually quantify that people are willing to pay for, right? So like, are people willing to pay, let's just call it $1 a month to have this on your phone, right? Or like whatever your business model is. And if it's working, it's just working, right? Like that's it. Like, even for the Headspaces of the world, taking a meditation outlook from offline to online, people weren't sure how much they were willing to pay for that. Now we know, right? So you are in slightly white space, which I think is fine. I actually am not, as an investor, concerned too much with market size. I'm more concerned with how you go after the market. So tell me what your distribution strategy is going to be. Tell me why your solution creates a wedge into that market. And from that wedge, you can grow into other areas, right? Mm-hmm. Tell me how you're going to get more dollars for your solution over time. So like if you're starting off with 99 cents, how do you get to $3 to $6, right? Whatever it is. I'm making up these numbers, by the way. I'm not saying that that's what you're supposed to charge. But I'm more interested in that than I am, oh my God, this is $1 trillion market, because we see those all the time. And that doesn't really matter to me, because if you have $1 trillion market that you don't know how to go after, it really makes no difference.
Okay, well, that brings me straight to my next question then is, how we like to see it articulated at a seed stage to understand how a company could monetize and scale.
At the seed stage, I'm actually more interested in growth and engagement than I am in monetization. I want to see some elements of monetization, but you have two choices, okay, at the seed stage. You could either say, look, I have tremendous growth, and we're giving this thing away for free, but on the back end, we will be able to monetize people, because when I get people away from their screen, I'm actually creating another monetization opportunity that's offline, right? And I can actually do attribution to that offline monetization. So I'm telling people, go play sports with your friends, go take a walk and buy a coffee, right? Like we'll walk you to the nearest coffee shop, like whatever. So there are ways that you can monetize. The thing I'm most interested in at the seed stages, do you have a spark, you know, like a little kindling of a fire that if you fed it, it would grow into this gigantic flame? And I'm interested in week over week, month over month, like user metrics, growth, engagement. And if you can, at the very early stages, say, you know what, we tested a freemium model and we know that people are willing to do this much if it's free, and they're willing to do this much more and they're willing to pay us, let's say 99 cents, great, right? Then I would come back and ask you, like, well, you're charging people, how much faster could you grow if you did it, if you gave it away for free? And we would go through this exercise, right, of saying if you spent venture dollars to acquire users, how much faster could you get them? Because the question is this a land grab situation where people aren't going to have 2 of these apps on their phone? They're going to have 1.
Right.
They don't need 2. And so if they only need 1, how do you make sure that you're on every phone? And then the other question I would ask for you is specifically is what happens when Apple finally rolls out their solution for this, which they have announced, right? So what are you doing that is different than what Apple is doing so that yours is the preferred, even though Apple has something? And maybe Apple's is just, hey, I'm just showing you a bunch of analytics. Yours is something that people actually actively engage in. Great. Show me that you can be just as effective when Apple starts to roll this thing out onto everybody's phone.
Right. So they actually just launched iOS 12 today, which then brings me to my last point, the competition part. Because I've connected with a lot of founders that are in different sectors, and there is always one classic question, and it's always about a tech giant recreating your idea. There's always like, what about Apple? What about Google? What about Amazon? So what is the best way you've heard this question being addressed?
From your perspective?
Or just you can give us an example of any company, because in reality, like, you know, Facebook could have been recreated by Google, and we can talk about many companies that there was that what if this. So just from the companies you met, what is some of the entrepreneurs that have given you some of the best answers that, you know, you still remember?
Yeah. The best answers are we are watching it, but we don't really care because the market is so big that there's room for multiple players. And that has to be true, by the way. You can't just say it. But like, we were very early investors in Waze. And when Waze came on first, everybody didn't understand. And they were like, yeah, that's not really that valuable. Then people started to realize it was valuable. And then Google came out with Google Maps and everyone said Waze was dead. And then Apple came out with Apple Maps and then everybody said Waze was dead. And they weren't. And the reason why they weren't was because they knew that they had better engagement than either of those 2 products. And in Apple's case, like, their maps were just terrible, so it didn't matter. But there was a lot of like hoopla in the press about the fact that, like, oh, this little startup is going to get crushed because there's this big company. But if you know what is the true north metric for your space, and I can't tell you what that is because I don't know, like, maybe it's minutes on app, maybe it's minutes flipped, you know, whatever it is. The fact that people are inviting friends, you have a certain virality to what you're doing that other people don't have. You just need to be able to tell that story. Now, the only exception that I would warn you about is if the existing networks are so calcified and you have to depend on them for distribution. So if Apple doesn't let your app into the App Store because they have their own thing, now you're kind of screwed, right? So the thing that you need to be careful about, and all investors are going to watch you for, is to make sure that you can actually distribute your solution. So we see a lot of things that, like, they only work because of Facebook ads or the Facebook algorithm. Well, then, you know what? Once Facebook changes their algorithm, these small companies are screwed. So as long as you are not in that situation where your ability to acquire new users is dependent on some bigger company or platform, you can be okay if you can show the engagement and growth metrics and, like, whatever it is that is your secret sauce. I'm not worried about that. a lot of investors will worry, but I mean, look, you already have 450,000 users, right?
Yeah.
Tell me what they're doing on it, right? Like, tell me how you're going to stay, like, tell me the data that you're getting about these people. I mean, like, you should be getting information, like, you know, when this is the normal time that everybody plays a game, like when HQ Trivia is dropping their next thing and we offer them this type of challenge, they're taking it. When we offer them a different type of challenge, they're not taking it. So you have all this data, all this A/B testing data on what you can do to get people to look at the screen versus not look at the screen. That's super compelling. And what can you do with that data? How can you use it? How can you sell it? How can you affect user behavior? That's all things that like you actually have a head start on compared to some of the bigger companies.
Mm-hmm.
So, but my biggest concern is I would be concerned about how you do your distribution, because you do not want to be in a situation where your cost of acquisition is very high because you are stuck on these big platforms. So I wouldn't get stuck on Facebook. I wouldn't get stuck on, don't get stuck on any of those guys.
Yeah, that has always been a strategy for us, is how to figure out a way that we control how do we get into the hands of the user without leaning on the tech giants, because they can change their pricing or they could disappear. So we've been focusing a lot of word of mouth and being on press, as well as using influencers.
Yeah. And also, figure out from a product perspective, like what can you build into the product that makes it natural for people to invite other people to be on it?
Yeah, that's something that we've already implemented, and we started to see people invite other people. One of the metrics that we keep looking at is time spent flipped off, and that's why I was saying I was excited that we hit 1 billion, because right now we looked at what other companies spend on Instagram or Facebook, and then we're trying to use the same metrics that get people hooked into getting into flip, so they get unhooked.
Yeah, absolutely. We're about to give my kid his first phone, and I have the same concern, so I'll have to put this on his phone.
Well, check it out, try it out, and let me know if you have any feedback.
Yeah, absolutely.
Thank you.
Yeah.
All right.
I hope that was helpful.
Thank you so much.
Yeah, thank you so much. Thanks, Christian. If you could just mute yourself so we get, everyone. So actually, we had a little bit of either a mishap or miscommunication, I'm not quite sure, but the third team is not here. They are based in Asia, so I don't know if something happened. I would like, though, however, since we do have you here, Cheryl, maybe you can just talk. Maybe you can just give us like sort of 10 minutes of your wisdom and things that you have learned as you've become an investor, things that you see entrepreneurs, especially of the stage that, are in our cohort right now, which is mostly pre-seed and seed, mistakes that you've seen them make and maybe, lessons learned. That would be amazing.
Sure. And you guys should just feel free to jump in and ask me questions. I think we talked about this a little bit. I think one of the biggest struggles that I'm seeing young companies face right now, one of them is around distribution. So cost of acquisition is high. We know that like Facebook ads are generally not working. SEO, it's so easy for a young company to get outspent by like large companies. And so you have this problem where, your venture dollars are just not going as far as they used to go. And it's really hard to bootstrap, when you're trying to do user acquisition. So that's one thing that, we're seeing companies struggle a lot with, including companies that we have funded, and they are using our venture dollars. So that's one thing. I think another thing that we see, particularly in sort of, digital health, some of the even like B2B spaces, is we're seeing companies develop good products, but those products may not necessarily be good companies. And what I mean is that need to think about as an entrepreneur, should my product exist as a feature on a bigger platform, or can it eventually become its own platform? And I know this is sort of like an academic question in the early days of a company, because you have to start somewhere, but you need to start in the place that gives you strong defensive footing in the competitive landscape. And a lot of times we see companies where even if they scale, they're ultimately just building what is going to be a nice feature on a platform. And if that's the case, you need to raise venture money commensurate with what you think the outcome of the business is going to be. So you can be a really awesome feature that gets bought for, let's say, $50, $70 million, but that means that you can't raise that much venture money because you're not going to be able to return the capital. So you can't be $30 million in and then realize that you're going to have a $50 million exit. Like, you have to look around the corner and know. Now, if you're a bootstrapped company that exits for $50 to $70 million, that's awesome. You should do that all day long. But that's one thing that we see entrepreneurs not necessarily, not that they're not thinking through, but I feel like they're not thinking about it enough. And so when they come and present, I often think, wow, this is a good business for you, but it doesn't necessarily mean it's a venture return business. And that's kind of a nuance that a lot of people don't catch.
Do you end up telling them that that's the case? That's what you feel, that it should be, it's not a venture backable business, but it's a great business they can run on their own? Do you tell them that?
I do.
Okay.
I do. What I tell them is I say, look, I think the amount of money that you should be raising is less than what you're looking to raise, because I think that the eventual outcome of this business is you're not building $1 billion company. You're building a $50-100 million company. And for that, you should probably raise no more than $3 to $4 million, because in that scenario, you as the founder will be super happy. You're not taking a ton of dilution. Your investors will be super happy because they'll have made good money on their invested capital, and everybody can do well. If you overfund the business, you're going to end up in the same place, and you will be very disappointed. So I do say that. And that's sort of, it's not something I say to everybody, but I do see that sometimes.
Got it. I am going to pick some questions here. Amy had a question. What are the solutions to the distribution challenges you had mentioned? For example, the Facebook ads not working, etc.
So interesting. So I will answer that in two parts. There's the part for B2B businesses, and there's a part for B2C businesses, because they are different. For B2B businesses, what I've seen that's very interesting is that some companies are, they're actually focusing a lot on distribution partnerships. And so they will partner with other people in the ecosystem that have complementary products, and they will co-sell or co-market together. They also will sometimes use their customer as their distribution channel. So especially for companies that are like B2B2C, using your customer as a distribution partner is often a nice way to do an end run on user acquisition. On the B2C side, it's a little bit trickier, and that's where I like to see companies that have inherent network effect. And so, be it a proposition that makes you want to invite other people, or I always use the example of Uber. It's like, yeah, sure, Uber could have been one of those things where it was one-to-one, hand-to-hand combat on user acquisition, Or it was such a delight when all 4 of us are standing at a street corner trying to get a cab, and one person uses Uber and their car shows up, and I'm like, what just happened? Like, how come that guy got a car and I'm still standing here? Like, the first thing I'm going to do is download this app that like helps me get a car. So you can also attack user acquisition on the non-online side as well, which can also have amazing network effect that a lot of times we don't think about in Silicon Valley because we're so used to living in the online world. But you know, on the B2C side, I think it is super, super difficult to wean yourself off of Facebook, Instagram, you know, whatnot. But the biggest things are finding elements of your product that are truly shareable or share-worthy, and, you know, bring those to the front of the consumer experience.
Got it. A bunch more questions just popped up. Here's a pretty simple, numbers question. Andrea wants to know, how can we optimally decide what percentage of equity we should offer for a small check? So $250,000 to $500,000 in the first round. What would you suggest, you know, as a later stage investor, like what would you think are reasonable percentages to give out?
Yep. I wouldn't give any percentage out. At that stage, I would actually do it as a convertible debt, because that is extremely expensive equity for you to give away. So anything, you know, I would say the pre-seed round and maybe even the seed round, depending on how developed the business is, I would do them as convertible debt. I would rank it 1 convertible debt, 2 safe note, and then 3 I would do as priced equity. When you get to the Series A, Series B, etc., I think rule of thumb is founders should expect to take somewhere between 20 to 25% dilution in each round for the whole round. And so you will roll those early notes into your next round. But I would punt that valuation question, because the chance that you will give away more than what you want is higher than is worth haggling back and forth over that.
Yeah, thanks for answering that question, because I'm sure many people will be asking that in office hours. So just wanted you to answer for me. Another question is, how do you feel about multiple bottom lines? Does that affect your assessment of a business?
You mean like double bottom line businesses that have social good components to them?
Yeah.
Is that
multiple bottom lines?
I don't inherently have issues with them. What I have found is that it takes a very special kind of founder to focus not on the second bottom line, but focus on the first bottom line first, and then grow that way. So ultimately, I have no issues with, you know, we want to do social good. This is something that's important. However, I would not compromise growth or financial return just for that second bottom line. Like, I have a fiduciary obligation, as all investors like me have, to return money, right? And if it makes entrepreneurs feel any better, a lot of my investors are pension funds and foundations, et cetera, that are nonprofits. And, you know, they've put money into our funds for the sole purpose of growing those endowments. And so that's what I have to be a steward of. So I would never say no to a double bottom line company, I guess, at the end of the day, but I would look very hard at the team to make sure that they have the right skills to continue to grow it in a traditional for-profit way.
Yeah, and I think this goes back to what you were saying earlier about, hey, certain businesses don't really necessarily need to be venture backed, and they could be bootstrapped or, find other ways of getting funding, and maybe serve that double or multiple bottom line well. I have another question.
Yeah.
So let's make this our last question, because we should let you go. There is, here's the question. Okay. Based on the B2C challenge you described, should we lean more towards Peter Thiel, i.e. spending more time creating a unique product, or more towards Eric Ries, launching a bare bones MVP, get it out there and get user data ASAP?
I think that depends on what you're building. I think that there are certain products that consumers will be very forgiving for, and there are certain products that consumers will be very unforgiving for. And so, for example, if you are trying to build the next Snapchat, and the first version of it is not perfect, but it has some little features that delight you, and it's catchy enough, whatever, you can do the Eric Ries model, right? And you can go and iterate and iterate and iterate until you get it exactly right the whole time growing. If you are in like consumer health, if you are in, certain consumer areas where it's really serious, where your margin for failure is actually very slim, no, you can't do that, right? So I'll give you this one example. I have a friend who will remain unnamed. It wasn't me, but I have a friend. They were trying to get pregnant, and they downloaded an app that was telling them about their ovulation cycles to help them get pregnant. Mm-hmm. But the app was basically wrong. It was actually the exact opposite. So they're basically trying to have a baby at the exact infertile time in every month. And so they try for 6 months to get pregnant. And finally, it's not working. They're getting ready to go do IVF. They go into the doctor, and the doctor's like, well, what have you been doing? And they're like, we're using this app. And they show him the app, and the doctor looks at the app, and he's like, but this app is wrong. It's just straight wrong. He's like, you're actually ovulating 2 weeks earlier. And so they're like, oh my gosh. So they're embarrassed. So they ditch the app, and then they literally get pregnant the next month. So there's certain things where it's no, you cannot iterate. You have to you just have to nail it. And so in those, so I don't mean to sound like I'm trying to cover all my bases, but there's a lot of different types of consumer technology, and some of them are just going to be more forgiving than others. And the only way that you're going to know is if you deeply understand your user, right? If you understand your user and you understand the value proposition that you deliver to them, you'll know which camp you would fall in. But I cannot say that empirically everybody should be in one or the other. I think if I had my way, I would find founders who are first in the Peter Thiel camp and they've nailed it. And then when they come to me, they've now moved to the Eric Ries camp because they're iterating and growing. But I know it's impossible to, to prescribe. So, I would just say it all comes down to your value proposition and your user and what people are willing to accept. I don't know if that helps, but.
Got it. Thank you so much, Cheryl. I think that we have run out of time with you. This was really helpful. We had, over 150 people joining for this session. Just before I let everyone else go, I wanted to remind you that we do have other speakers coming up talking about Vic Stretcher, talking about how to become an evidence-based entrepreneur, which is something Cheryl spoke about briefly in the beginning of this session. And then also we have Nadeem and David who will be doing a session on how to sell into enterprise before you die. So hopefully that's also helpful to some of you out there as well. So again, Cheryl, thank you so much for your time today. And then we will see everyone in our next session. Thanks again, Cheryl.
Great. Have a good night. Bye.
Bye.